Thank you for joining us again on this program, Capital Market. I'm Temple Ashaji. Welcome on board. Nigeria this week continues to reap the benefits of improved macroeconomic stability as shown by the economic data released by the National Bureau of Statistics as well as the Central Bank of Nigeria, that's the CBN. Because on Tuesday, the NBS released the fourth quarter 2017 GDP data, where economic activities reportedly rose 1.92% year-on-year in that period, and that's marking the second consecutive expansion in growth since the economy exited recession in the second quarter of last year, 2017. The successive positive GDP growth recorded from the Q2 to Q4 2017 offsets the 0.9% year-on-year contraction in the first quarter of last year, resulting in full year 2017 actual growth of 0.83% year-on-year. And that's 13% or 13 basis points ahead of some initial projections, major initial projections by a lot of analysts. But in the Nigerian capital market, the month of February was a bit negative. There was a lot of sell-off, some bargain hunting, some entries in the stock market and in the bond market, the debt market where you have bonds and treasury bills, a bit of sell-off, a bit of bargain hunting there too, as the 10-year benchmark bonds continue to taper with a lot of negative sentiment seen across the T-bills sector. Joining us to discuss what's transpired in the capital market for the month of February is a research analyst with Vetiver Capital Management, Tomini Yuramon. Thanks again for joining us on the program. So good to have you here. Walk us through what you monitored in the Nigerian capital markets in the month of February. Would you like to start with equity or you prefer the debt market?
Yeah, let's start with equity. For the month of February, it was a bit bearish. I mean, compared to January, remember in January we saw bullish runs across most stocks. I think in January we were up about 15% for the month, or with we saw key advances across tier 2 banks and in key stocks on the Nigerian Stock Exchange. However, for February we're down about 5% for the whole month, and that was due to a couple of factors. Let me take them one by one. So I think key among the factors, one, you will recall that in February there was slight profit taking across most stocks. Or in January we've seen significant rally around most stocks. Even some stocks in the banking sector rising as much as 100%, even some going up to 200% in January. So we saw some form of profit taking across such stocks in February. And also you recall that during the first week of February, so we had this global decline in stocks due to the concerns of investors about possible hike in interest rates in the US. So that actually filtered into the Nigerian market. So in the first week of January, for example, we were down as much as 330 bips for the first month. And in fact, most of the decline we saw in the month of February actually came from that month. And the following week, these declines actually continued, but not as severe as what we saw in the first week of February. And even in the third week, things actually got better. I think after most stocks have been beaten down in the first 2 weeks, so we actually saw some bargain hunting, as you said, and mostly tier 2 names and some in the consumer goods space. But things actually stabilized basically in the final week of February. For the fixed income, compared to in January as well, it was a bit bearish. And I think both in T-bill space and the bond space. So, and that was also due to a couple of factors. One, liquidity was relatively tight in February, and also concerns around increase in US interest rate actually filtered into the Nigerian market. So we saw movement in the yields on Nigerian securities, and most of the advances in yields actually came from the short end of the yield curve. That should be around the 0 to the 1 year bill. For the bond space, however, after the first week of declines, first week of pressure, so we actually saw sentiment change from the second week, and that was actually due to the bullish sentiment that actually followed the announcement of raising of the Eurobond in February. So that actually improved sentiment, and from that period actually, so we actually saw some renewed interest in most of these benchmark bond. Aside that, after the second week, we saw a little bit of drop in the pace of OMO in the fixed income market. So that actually supported liquidity in the fixed income market. And just like the usual trend, when you have more liquidity in the system, you tend to see a lot of buying in the market. So overall, for the bond space, it was mixed generally. After the first week of decline, we saw moderation. We saw a little bit of more stability in the following weeks. But for the equity space, as I said, things actually improved, but not as much as we saw in the bond fixed income space.
Because a lot of investors moved to the equity side of the market. But let's take a look at the bond auctions as we had them. We had one in February. How did that pan out for you?
In fact, I think that's another factor that actually pressured yields in February, because you recall that the bond auction, the stop rate actually closed slightly higher than what we had in the secondary market then. So we saw this form of adjustment in the secondary market. So we saw this kind of increase in yields across the curve, particularly in the bond space. So I think about 10 to 15 bips increase in yield following that bond auction. And even aside that, the CBN actually kept rate relatively high in the fixed income market. Yeah, just trying to keep in line with the inflation we have in the economy.
So what's your projection for March? Let's march into March now.
For March, for equities, I foresee a very mixed trading session in the month, and so I think basically, given that we expect a lot of earnings to roll into this month, you agree with me that compared to previous years, earnings season has been a little bit slow. We've not been seeing a lot of results, particularly from the banking space, even from the other key sectors like industrial goods sectors or the oil and gas. We've not seen a lot of earnings. So I think we will see more of earnings in March. So depending on how investors actually see these earnings, we'll most likely see mixed reactions from them. And when you have mixed reaction that way, you tend to see either direction for the ASI and then over the course of the month.
And what are kind of the factors or key drivers that is expected to help push the market this period beside earnings?
We don't really have a lot of catalysts.
Because we're not sure about budget implementation or budget passage?
In fact, if we were to go by historical performance for budget passage, it's not really positive for the Nigerian market. So I think investors will be keen on, one, earnings. The big names, particularly from the banking sector and the other key sectors. I think investors will watch out for those names. The expectation is for the banks, for example, the tier 1 names are expected to remain resilient. Full year results from tier 2 names might not be particularly impressive. We think most of the improvement we believe we'll see in tier 2 names will most likely come from Q1 2018. So for the oil and gas space, for example, apart from the upstream guys, we are not really positive on the downstream guys, given the kind of pressure we have in the sector currently. So I think earnings will be key to the market performance in the month of March.